Welcome to another edition of BCR Webcasting. Today I'm delighted to be joined by Matt Wreford. Matt is CEO of Demica, and Matt is going to be speaking at our second Trade and Investment Forum, which will take place on the 16th of April in London, and we're holding that event in cooperation with IDFA. Matt, welcome.
Hi, Michael.
So Matt, we've had a little bit of a chat before we started recording this, and it sounds like there's a lot of interesting stuff going on in this space, the whole area of investors and their interest in receivables in terms of banks and institutional investors. But we're going to focus on investors more than banks, and I'm interested to get your views on the returns for investors. I mean, do you think returns for investors in this space are sufficiently attractive?
The answer is increasingly so for a number of different reasons. Historically, it's been challenging for institutional investors because they've been originating assets from banks that are focused on serving large investment grade clients. And so on relatively tight spread. And the banks have been able to do that business efficiently because they have themselves very low cost of funding from deposit bases. That wasn't a good fit for institutional investors that have a promising absolute return to their client base. What we've seen in the last 12 months is that institutional investors have been sourcing ever lower cost of capital themselves, whether that's managing expectations with LPs or putting low cost senior debt into the structure of their own funds. And that has meant that the strike price that institutional investors have been seeking for particular types of risk have narrowed. And so the gap between what's being originated by banks and what institutional investors want is now starting to match more closely. That's the first big change in the market in the last 12 months. The second thing that Demica has seen is there is greater demand for receivables finance from corporate clients. And because floating rates like SOFR have risen and the price of cash flow lending has widened, the pricing on these types of assets has gone up. So to give you some statistics, Demica originated $5 billion of receivable transactions over the last 18 months, of which 3 billion have been funded so far. And of that 3 billion, 690 million, i.e. approximately 25%, have been funded by institutional non-bank investors. So 25% of Demica's flow now goes into that part of the market. That number was a quarter of that last year.
Yeah,
right.
So interesting. And I know you've recently done a benchmark survey with some interesting stats for 2023. I don't know if you want to bring that up. Right?
Let me bring that up for you and share what we're seeing. So, Demica basically surveys around 200 trade finance bankers each year, asking them a broad range of questions around the market, the direction, its growth. It's the largest survey of its kind by a country mile. And what I'm going to share with you now, Michael, is the flash results for 3 questions we asked around risk distribution. The report won't be published for some weeks yet. But I thought you'd be interested to see, hot off the press, because the survey only closed, I think, 10 days ago or something. So this is a question we asked bankers: what percentage of their book was being distributed? And you can see that 5% of the respondents are saying over 40% of their payables and receivables book is distributed, and another 20% or thereabouts was between 20 and 40%. This wasn't totally unsurprising. We've all known that some of the large banks like Citi distribute a very significant proportion of their book. But I was a little surprised to see the degree that we're in the 20 to 40%, right? I think in the last 12 months, and we didn't run these questions previously, but my intuition tells me in the last 12 months that the middle bar has grown quite significantly. Banks are selling down more in response to regulatory capital changes anticipated or otherwise, as well as in response to cost of their own liquidity following Silicon Valley Bank. and perhaps more thoughtful views on credit underwriting that's taking place. And these things create the opportunity for greater sell down, right, rather than moving away from a buy and hold model. So that's what's happening on the sell side. But let's look at the buy side for a moment. And this is really interesting, right? What you're seeing is 20% of people are originating more than 40% of their assets from other banks. Because don't forget, this is a bank only survey. And nearly 20% are in the 20 to 40%, right? So 40% of the market is originating over 20% of what they do from other banks. That number must be much larger today than what it used to be, right? The market could be characterized previously as a relatively few number of large banks selling down to a relatively few number of buyers. The numbers of buyers have risen hugely, more so than the number of sellers. So the market's getting more complicated. And for the first time, institutional investors are becoming much more significant. You know, if we look at this, you can see it's still very much a bank-to-bank market. Just over 80% of the book is being sold to other banks. But that means nearly 20% of the book is 17% of the book is being sold to non-banks. That's fascinating to me. Right. And that accords to what we see.
As mentioned, we don't have previous years to gauge the progression here, but your instincts are that this is changing, and institutional investors are getting more interested in the space.
Definitely. They're much increasingly more sophisticated. They're broadening the breadth of products that their funds can purchase, and the scale, and with lower cost of funding on their side, the scale of what they can buy has increased a lot.
Which presumably means they're getting to understand the sector better, because that was a concern which came up in our event last year, that institutional investors particularly don't really understand this sector very well. So this suggests that's changing.
Yeah, I mean, Demica has over 250 banks and non-banks under NDA in its distribution network, of which 100 are institutional investors. That number has doubled in 12 months. They've been hiring experienced trade finance bankers and other relevant people from the sector. So yeah, I don't think our distribution team would tell you that the market needs, that they're unsophisticated or they need educating. Some of the new entrants do, particularly those funds that are generalist funds that can buy receivables but also do other things. But there have been a very large number of new entrants that are setting up dedicated teams to focus on this space.
What role is technology playing in attracting people into this sector? Because you've got data coming in all sorts of different formats from all sorts of different places, which is difficult to manage and put together. So, how is technology playing a part?
Technology is becoming an ever more important part of it. It's probably still at its earliest stages, risk distribution and trade finance from a technology perspective. But Demica's large bank clients who white label the platform are increasingly coming to us wanting technology solutions to manage this. So when you think about the scale of the market, right, we process 6-7 million invoices a day, right? So if you try to risk distribute that manually, it would be almost uncontrollable. So what we're seeing is that's got a combination of more sellers of assets, more buyers of assets, and more counterparty credits growing. The need for technology to simplify it and automate it is becoming ever greater. I also suspect the operational risk that's being run, particularly by the buyers of assets, has also risen materially. Imagine you are sourcing assets from, say, 20 different financial institutions across, with different formats of reports, with different data structures. The probability of an operational error will rise and will continuously rise over time. Let's take a simple example. Let's say the date, so you're buying from European banks with European date format, and you're also doing the same with US banks with US formats. Probability of you getting one of those confused at some point is quite high, and in which case your calculations of tenor will be completely out. So yeah, we think that this will be the next big growth area in the market from a technology perspective. And I think if you spoke to any of our large bank clients, they'd say the same.
So this is a key, very important driver in terms of growing this market and accelerating that growth.
Yeah, totally. I mean, one of the things that's odd about the trade finance market is it looks like the fixed income market did 20, 30 years ago, right? It's still, it's private, it's opaque, it's relatively bilateral, right? People risk distribute manually using spreadsheets. They choose who they want to sell to. The person will select the invoices they want to have. So it's an offer and acceptance market. It isn't an automated and cleared space. And if the risk distribution side of the market is going to grow, the way that practitioners transact with each other will need to change, where to move to a scenario where buyers will load up their preferences of assets they want to buy, and sellers will load up the assets they're wishing to sell at what terms, and then systems will match off them, and then bulk transactions will take place at very high scale.
And this is a relatively young sector, and these are all signs of maturation in the sector.
I think so. Yeah. I mean, you're right. I mean, it's really interesting, right? Trade finance has been around for decades or hundreds of years, in fact. But the concept of risk distribution is very new in the grand scheme of things. This point about only a handful of banks have been selling down at a real scale for a long time. So as you get new sellers and new buyers and a movement from bank to bank and non-bank capital, the needs of the market will evolve quite significantly.
Matt, this sounds like a really interesting sector, and we'll certainly want to keep an eye on what's happening and developing. And we look forward to hearing more from you on the 16th of April.
I'm looking forward to it, Michael.
Once again, that's at our Trade Investment Forum, which will take place in the city, and we're cooperating with ITFA on that. And if you want more information, you can go to our website at bcrpub.com/events. Matt, thank you very much for your time, and look forward to speaking to you soon.
Thank you, Michael. I look forward to it.